I broke down the fastest way to $5,000 per month in dividends. What if I told you there's a number, one single number, that once you hit it, you never have to work for money again? Not win the lottery money, not start a billion-dollar company money, just consistent, boring, recurring cash that lands in your account every single month. Whether you show up to work or not, whether you're on vacation, whether you're sick in bed, it doesn't matter. The money still comes. That's the promise of dividend investing. And today we're talking about a specific target, $5,000 a month or $60,000 a year entirely from dividends. That's enough to cover rent or a mortgage in most places, groceries, bills, and still have breathing room, all without touching your job income. Most people who hear about this assume it takes 30 or 40 years, so they never even start. But that assumption is usually wrong because it ignores the specific things you can actually control to speed this up dramatically. In this video, I'm going to walk you through this in 5 clear points. How much money you actually need to hit $5,000 a month. The 2 philosophies of dividend investing, yield versus growth, and which one gets you there faster. The 3 levers that speed everything up. A real, concrete portfolio example, so you can see the math in action. The common mistakes that quietly add years to your timeline. By the end of this video, you'll have an actual plan, not just a wish. Let's get into it. Point 1. How much money do you actually need? 130 to 430. Before we talk about fast, we need to nail down the target, because most people get this number wrong in one of 2 ways. They either wildly overestimate it, thinking they need $5 million, or they underestimate it and end up disappointed when reality doesn't match the dream. Here's the simple math. Dividend income comes from yield, the percentage return a stock or fund pays you each year just for holding it. If your portfolio averages a 4% yield, $60,000 divided by 0.04 equals $1,500,000 invested. If your portfolio averages a 6% yield, $60,000 divided by 0.06 equals $1 million invested. If your portfolio averages an 8% yield, $60,000 divided by 0.08 equals $750,000 invested. So, right away, you can see the lever sitting right in front of you. The higher your average yield, the less capital you actually need to hit $5,000 a month. But, and this is the part most get-rich-quick dividend videos skip. Higher yield is not free. It almost always comes with a trade-off. Higher yield stocks and funds tend to be more volatile. They're more likely to cut their dividend during tough economic periods. Some high-yield products barely grow their share price at all, meaning you're trading long-term growth for short-term cash. So the real question isn't, what's the highest yield I can find? It's, what's the highest yield I can find without taking on excessive, unnecessary risk? That's the balance we're solving for in the rest of this video. Point 2, yield versus growth. The 2 paths, 430 to 730. There are really 2 philosophies in dividend investing, and understanding both is key to going fast without blowing yourself up financially. Path A, high current yield. You buy stocks, ETFs, or funds that already pay a large dividend today. Think real estate investment trusts, REITs, business development companies, BDCs, covered call, ETFs, high-yield dividend aristocrats. The upside, you get more cash sooner. The downside, growth is usually slower, and payouts can be less stable if the underlying business hits a rough patch. Path B, dividend growth investing. You buy companies with a lower yield today, maybe 2 to 3%, but that increase their dividend every single year, often by 8 to 12% annually. Your income snowballs over time through compounding, but starting from zero, it takes longer to reach a big number. Here's the key insight if your goal is speed. Starting from scratch, a blended approach almost always wins over picking just one philosophy. You anchor your portfolio with a core of stable, growing dividend payers for long-term safety and compounding. You layer in a slice of higher yield holdings to boost your current income right now, so you're not waiting a decade just to see meaningful cash flow. This combination gives you real, usable income today, while your growth core keeps compounding quietly in the background for the long run. Point 3, the 3 levers that speed everything up, 730 to 12. This is really the heart of the video, the actual practical levers you can pull to shrink your timeline. Lever 1, increase your contribution rate. Not just your stock picks. Most people spend 100% of their energy on which stock pays the most, and 0% of their energy on how much new money am I adding every month. That's backwards. The single biggest speed multiplier is your monthly contribution. Someone investing $2,000 a month reaches their number dramatically faster than someone investing $200 a month, regardless of yield differences. If your goal is speed, the unglamorous answer is increase your income where you can, cut unnecessary expenses, and route the difference straight into your dividend portfolio every single month. Lever 2. Reinvest every dividend until you hit your target. This sounds obvious, but so many people spend their dividends early because it feels like free money. Every dollar you reinvest buys more shares. Those extra shares pay you more dividends next time. Those new dividends buy even more shares. This compounding loop is what turns a 10-year plan into a 6 or 7-year plan for the exact same monthly contribution. Reinvesting isn't optional if speed is the goal. It's the engine. Lever 3. Use tax-advantaged accounts. First, depending on where you live, retirement or tax-advantaged accounts, let your dividends compound without being taxed every single year. Losing 15 to 30% of your dividend income annually to taxes is like quietly adding years onto your timeline for nothing in return. Maxing out tax-advantaged accounts before investing in a regular taxable account is one of the most underrated speed moves in this entire strategy, because every dollar saved on taxes is a dollar still compounding for you. Point 4. A real portfolio example. 12 to 15. Let's make all of this concrete with a hypothetical portfolio blend. To be clear, this is an educational example only, not a personal recommendation. 50% in dividend growth stocks/ETFs, averaging a 2.5% yield, growing dividends 8 to 10% per year. 30% in higher yield dividend ETFs, or REITs, averaging a 6 to 7% yield. 20% in high yield covered call funds, or similar, averaging 9 to 10% yield. Blended together, this portfolio might average somewhere around a 5% overall yield, while still keeping meaningful long-term growth built into half the portfolio. Using our earlier math, that puts your target investment at roughly $1,200,000 or $5,000 a month in income. Now here's the speed part. If you invest $2,500 a month into this blend and reinvest every dividend along the way, with conservative overall returns, you could realistically be looking at reaching this number in the 12 to 15-year range. Compare that to 25 to 30 plus years for someone investing passively without reinvesting dividends or without any growth component at all. That's the real difference in this video. The gap between someday, maybe, and an actual plan with a realistic date attached to it. Point 5. Mistakes that slow people down. 15 minutes to 17:30. A few things quietly wreck people's timelines, and I want to call them out directly so you can avoid them. 1. Chasing yield blindly. A stock paying 15% is often paying that much because the market expects a dividend cut. Chasing it without doing your homework can set you back years if the payout actually gets slashed. 2. Panic selling during downturns. Dividend investing rewards patience above almost everything else. Selling during a market dip locks in your losses and interrupts the compounding you've spent years building. 3. Spending dividends too early. Every dollar spent instead of reinvested is a dollar that will never buy you more future income. It feels good in the moment, but it directly slows your timeline. 4. Ignoring fees. High expense ratio funds quietly eat into your returns every single year. It doesn't feel dramatic in the moment, but compounded over a decade or more, high fees can cost you years of progress. 5. Not diversifying across sectors. Loading up entirely on one sector, say only REITs or only energy stocks, exposes you to sector-specific downturns that can hit your entire income stream at once. Let's bring it all together. Figure out your target number based on your desired blended yield. Choose your approach. Pure yield, pure growth, or, usually best for speed, a blend of both. Pull all three levers, increase your contribution rate, reinvest every dividend, and use tax-advantaged accounts first. Use a real, diversified portfolio structure, not a guess. Avoid the 5 mistakes that quietly add years to your timeline. Do this consistently, and $5,000 a month in dividends stops being a fantasy and starts being a math problem with a deadline attached to it. If this helped you, hit subscribe, because next week I'm breaking down. Drop a comment below with your own dividend income goal. I read every single one. See you in the next video.